Hey everyone, welcome back to our channel. In today's video, we'll be discussing an important financial decision for many newcomers to Canada. That is, whether or not to contribute to a registered retirement savings plan, otherwise known as RRSP. If you are new to this channel, I want to give you a very big shout out and I want you to subscribe to the channel. And if you like the video, give it a thumbs up and click on the bell icon so that whenever we post a new video, you'll be notified and you will never miss a thing. So, what is an RSSP and how does it work? So, an RSSP is a tax advantage investment account that is recognized and registered with the government of Canada. It is tax deductible, meaning that whatever you contribute to an RSSP can be deducted from your tax for that year. And it has special tax advantages. So, what makes RSSP one of the most attractive investment option for many people in Canada? I will explain using an example. Let's consider someone, maybe we call him John Doe, who earns say 100,000 annually, and let us assume that his annual tax rate is 40%. So if this person makes no contribution to an RSSP, he will pay taxes of 40,000 to the government. But on the other hand, if this person makes a contribution of say $10,000 to an RRSP account, his taxable income will become 100,000 less the 10,000 he contributed to the RRSP. Therefore, he will be paying taxes of just $36,000, thereby saving 4,000 in taxes. Another benefit of the RRSP is the fact that it has the potential to lower a person's tax bracket. You know, in Canada, the more you earn, the more you pay, right? So let's assume this same person who earns 100,000 contribute 10,000 to an RRSP. His taxable income will reduce from 100 to 90. If the tax rate for people earning 90,000 and below is say 35,000, that means 35% rather, that means he will be paying taxes with 35%. 35% of 90,000 becomes 31,500. This person would have saved 8,500 of taxes that year. So RSSA has the potential to lower the taxable income and also lower the tax rate, thereby making a person to pay less taxes. It is actually designed to help Canadians save for retirement. So that is why they call it tax later. You pay the tax at retirement when withdrawing the money. Now, having said this, what are some factors that a person needs to remember about RSSP? I'll talk about four. One is a contribution limit. So the annual contribution limit is based on the person's earned income with a maximum limit set by the CRA. And you can carry forward unused contribution to future years. Secondly, the deadline to make an RSP contribution for a given tax year is typically March 1st or the next business day if March 1st falls on a weekend. And withdrawals, you can withdraw for an RSSP, but they will be subject to taxation. So whenever a person makes a withdrawal, the money is taxed. Also, the home buyer's plan allows a person to borrow up to 35,000 from their RSSP account and pay back within 15 years tax-free. Then finally, lifelong contributions. So you can contribute to an RSSP until December 31st of the year that you turn 31. After that, you must convert your RSSP to either a registered income fund or an annuity. We'll talk more about this in another video. Now, having learned all of this, what are some factors that a person needs to consider before contributing to an RSP account? One important factor is your current and future tax rate. So for many newcomers to Canada, they start with beginner job, customer service, Uber driver, handyman, just name it. And all of these jobs are low income, which also means they are low tax bracket as well. So as a person climbs in their career, they get a higher job, become a manager, senior developer, executive vice chairman, or whatever, any big money, and also adding all the benefits they will be getting. Maybe they have some retirement income or they have some non-registered accounts, rental properties, and all of that. They'll be earning big. That means the tax bracket will be higher later on in life. So what that simply means is, as a newcomer to Canada, if you are contributing to an RSSP, there is a likelihood that the taxes you are not paying now, you will pay them where you are at a higher tax bracket, meaning paying more for taxes later in life. Is that what you really want to do? I don't think so. That is why it's important that you consider this factor before deciding to contribute to an RSSP or not. Now, having known this, what are some alternative investment options that a person may consider to invest in? One of the most important one we consider is a tax-free savings account, otherwise known as TFSA. So with the TFSA, a person earns the income, pays taxes to CRA, opens a TFSA account, contributes some of that money to the TFSA account, and the growth is 100% tax-free. Now, this is something that we need to really clarify because a lot of people don't know what tax-free means on inside tax-free service account. So when we say tax-free, we're actually talking about the growth. So if you contribute, say, $10,000 and this money grows, there's maybe $5,000 on top of it. It is a 5,000 that is tax-free. Although you are not paying taxes because you're actually contributing after tax dollars to this account. So that's what makes it really great. So even at retirement, when you withdraw this money, you will not pay any taxes. So whether you're at a higher or lower tax bracket, then it doesn't really matter much. Here are some quick facts about the tax-free savings account that you should take note of. Number one, the contribution room is set by the government and it accumulates over the years. And you can move the contribution limit from 1 year, okay, to another year. So if there are any unused contribution room, you can carry them forward. And any withdrawal you make, okay, from a TFSA account also count as a withdrawal room for the following year. Okay, so meaning that you can contribute this year, withdraw the money, okay, that opens that room for you to contribute in the next year. And there are no income tax deductions. Unlike the RSSP, contributions to the TFSA are not tax deductible, okay? But as well, you don't pay tax on them, as we have mentioned, when you withdraw those money. Very important too, TFSA withdrawals have no impact on government benefits. You see, with your RRSP, when you withdraw from your RRSP, how much you withdraw can impact how much you will qualify for with the old age security or the guaranteed income supplement government benefits. So this is something very important that you need to keep in mind while deciding whether you are going to contribute to an RSSP or a TFSA. And finally, you can actually designate a beneficiary so that if a person passes away, it's easy to transfer the money to the next generation without going through any probate. Now, let us look at another interesting option, the First Home Savings Account, otherwise known as the FHSA. So the FHSA, the person earns income, pay taxes, contribute to this account, and just like the RSSP, this money is tax deductible. That is why I call the FHSA RRSP plus TFSA, because as you make contributions, the interest also grow 100% tax free. This type of account is actually designed to help people, Canadians, save for their first home. And withdrawals from the first home savings account are also 100% tax free as long as the person is using them to purchase their first home. This is a really great investment option for people. And here are some quick facts about the first home savings account that you want to keep in mind. Number one, eligibility and contribution limits. So to be eligible for the first home savings account, you must be a Canadian resident and a first-time home buyer. Number two, accumulating a down payment. So the primary purpose of a first home savings account is to accumulate a down payment for your first home, not for any other purpose. Keep this in mind. Tax treatment of contributions and withdrawals. So contributions made to the first home savings account are tax deductible, just like the RRSP. So it can also help to lower your taxable income in a year. And number four, lifetime. So you can only take advantage of this type of account once in a lifetime. In some special circumstances, maybe if there's divorce or separation and a person wants to buy a home, they may have the opportunity to take advantage of this type of account again. And finally, take note of related timeframes and restrictions. It's important to know that there may be certain restrictions and timeframes associated with a first home service account. So if you put the money in, you might be required to wait for some time before the funds are withdrawn. Or if you don't use the fund for a qualifying home purchase, there might be some penalties from the government. This is very important to note as you open your first home savings account. Another interesting option is a non-registered investment account. So again, you earn income, pay your taxes, start a non-registered account, invest the money in whatever type of investment. Okay, your interest grow, but it is taxed. The good news is not all of it is taxed. Only 50% of the growth is taxed. So this type of accounts are actually non-registered, so there are no tax advantages. But the beauty of it is that it provides flexibility and liquidity. You can use to buy a second home, get a new car, travel the world, right? And invest without limits, allowing you to withdraw whenever, wherever you need this money. Here are some quick facts about the non-registered accounts. Number one, taxation. So in non-registered account, you are required to pay taxes on the income and the capital gain. So this may include interest, dividends, capital gains from sale of investments. All of these, you are required to pay taxes. In most cases, it's 50% of the growth that that investment has acquired. So you are going to pay taxes on just 50% of the growth. Number two, no contribution limit. So there are no limits on how much money you can contribute to a non-registered account. You can invest as much as you want and withdraw your funds at any time without any penalties. Number three, as for reporting, you are responsible for reporting the income and capital gains from your non-registered account on your annual income tax rate. And number four, tax efficient strategy. So while these type of accounts do not have any tax sheltered growth like the TFSA, RRSP, and FHSA we talked about, there are some advantages of capital gains that we'll talk about that eligible Canadians can take advantage of that can help them save money. And finally, income splitting. So you may have some flexibility to split income with your family members through various strategies that can potentially reduce the overall tax liability each year. We'll dig deeper about this in another video. Now, what are the key takeaways? Number one, RRSP is a government registered retirement service plan. So there are tax advantages. Number two, it is best to contribute when a person is earning a higher income. So when you're making a big dough, you can contribute to an RSSP to save taxes, right? Reduce your taxable income and all of that, right? And number three, it is best to calculate and estimate your current and future tax rates before choosing to contribute or not. And it's good to take advantage of employer matching where that is available. Okay. And as we have emphasized earlier, you can consider other alternatives such as the TFSA, FHSA, non-registered account, and so on and so forth. But very important, each individual or family circumstances are different. That is why we emphasize that you discuss with your financial advisor before making a decision of what is best for you and your family. So thank you very much for watching this video. If you have found value from what you have seen today, I encourage you to like the video, okay, share it so that more people can see it. They can come, learn the way you have learned today. Also subscribe to the channel, click on the bell icon so that you'll be notified whenever we upload a new video. Thank you and have a blessed day. Bye-bye.